You are listening to Jason Bolzano's article, Germany's Economic Struggle. Can optimism cure a deeper crisis? We're still hearing some disappointing news about Germany's economy. While there have been a few small positive signs, the underlying structural problems have reached a point that even Chancellor Olaf Scholz has to acknowledge. Scholz admitted that Germany is stuck in a vicious cycle. Bad numbers lead to a bad mood, and that bad mood in turn creates even worse numbers. But is an economy really going to recover just because people are feeling optimistic? Germany's got some pretty deep-rooted structural issues that aren't going to be fixed with just a bit of optimism. It's like giving a cancer patient a pep talk. So, what's behind Germany's economic woes? Germany has faced economic slowdowns before, but it's always bounced back thanks to its strong industrial base, skilled labor force, and stable government. This time, though, it's not that straightforward. We're seeing a decline in consumer spending and production investments in the German economy. Recent estimates show that tax revenue will fall short by 60 billion euros over the next 5 years, making it harder for the government to cover rising expenses. This will make things even more difficult for the three-party coalition government, which is made up of the SPD, the Greens, and the FDP. There's a general slowdown in the German economy, with consumers spending less and reducing demand. Fewer orders mean slower production. We're seeing a drop in equipment and machinery purchases that's similar to what we saw during the pandemic. German firms aren't buying new machinery, which shows they're not as confident about the future as they once were. They can currently meet low market demand with their existing capacities, but this shows their declining faith in the country's industrial growth potential and that the gears of the economy are grinding slower each day. China's economic growth is also having a negative impact on Germany. In the past, China was a big market for German products, buying a lot of them. But China now makes many of the same products it used to import from Germany and sells them all over the world. Even in Germany, German companies are struggling to compete with Chinese-made products. A lot of German companies with manufacturing operations in China are now supplying products back to Germany, which is reducing the country's exports to China. China's electric car sector is booming, for example, which has led to more imports from China while exports to China have fallen. Another big issue for Germany is the war in Ukraine and how it's affecting energy prices. Because of the conflict, Europe can't get Russian gas and oil anymore, so Germany has to get its supplies from the United States, which are pretty expensive. This has led to higher production and energy costs. With the closure of nuclear power plants and the move away from traditional energy sources like coal towards more expensive renewable energy, the country is becoming more reliant on costly wind and solar energy. While these green policies are good for the environment, the rising electricity and heating bills have led consumers to cut back on spending, which is slowing down economic growth. On top of all that, Germany has also lost a big market in Russia because of the war. Before the war, Germany had invested billions of dollars in Russia. Russia was a great market for German-made cars, electronics, and other industrial products. Unfortunately, this trade relationship ended with the war, which meant Germany lost a significant income source. Germany's losses are pretty similar to Russia's. They've lost both their investments and the income they generated from exports. The rise in prices caused by the pandemic has made the structural problems in the German economy even more obvious. The government introduced high interest rates to tackle inflation, which has had the knock-on effect of slowing the economy even more. While inflation and interest rates have eased a bit recently, Germany's deeper structural issues have come to the fore. German industry is finding it tough to compete, thanks to high labor costs and complex tax regulations. One thing German companies are really worried about is labor costs. The high cost of hiring new employees is putting a damper on many companies' willingness to make new investments. It's much harder and more expensive to hire or fire someone in Germany than it is in the US. This creates a big bureaucratic burden on the German labor market and makes it harder for companies to adapt to changing needs. Germany's industrial infrastructure is also getting on in years. From railways to factory equipment, there's a need for modernization investments across the board. But with budget deficits on the rise, it's becoming tougher for the government to ramp up public spending. For a country like Germany, where investing in infrastructure is crucial, this is a significant challenge. SMEs, which are the backbone of the German economy, are also struggling. A recent survey in Germany found that 37% of 3,300 small and medium-sized businesses are thinking about cutting back on production or moving their operations abroad. Last year, this figure was 31%. This year, it's up to 37%. This shows that even small businesses are finding it tough to stay afloat in the country due to rising costs and competitive pressures. It's a sign of big changes in the German economy. These businesses are important for the labor market and also make a big contribution to the tax base. 99% of all companies in Germany are small businesses. They're the foundation of economic growth and employment. But with costs going up and economic uncertainty on the rise, they're looking to operate abroad, which hurts economic activity at home and could lead to a long-term drop in economic growth. Even Volkswagen, one of Germany's biggest companies, is having trouble. The company has decided to close 3 of its 10 factories in Germany and is planning to lay off employees from its other factories. Rising production costs in Germany have forced the company to take such measures. It's now cheaper and more profitable for Volkswagen to produce in China or other countries than in Germany. If Volkswagen cuts back on production in Germany, it could spell disaster for hundreds of suppliers and subsidiaries. Big car manufacturers like Volkswagen buy hundreds of parts from other companies, from headlights to sound systems. This puts more pressure on small and medium-sized businesses in Germany. The fact that companies like Volkswagen are producing abroad not only helps them but also affects the German economy as a whole. Germany's economic growth outlook for the 2024 to 2028 period predicts long-term stagnation, which is also reflected in IMF reports. Germany is expected to have the lowest growth rate among the G7 countries, with a growth forecast of less than 1%. Germany's expected growth rate for 2025 is around 0.8%. Germany was once known as Europe's economic powerhouse, but it's now the slowest growing economy in Europe. It's the first time in over 20 years that we've seen prolonged economic stagnation. The German government has warned that there's a chance of an economic downturn in 2024. They're more worried about a decline than growth. Typically, economic recessions are followed by a period of recovery, but we haven't seen that happen in Germany yet. It's not just the big companies like Volkswagen that are feeling uncertain. The small and medium-sized businesses that drive the German economy are also in a tricky spot. It's clear that Germany's economy needs a big shake-up and some modernization. We need to cut down on bureaucracy, make taxes more affordable, and make it easier for businesses to adjust their labor costs. Otherwise, it'll be tough for Germany to regain its economic leadership. The German economy is in a bad way, and will need to make some big changes over the next few years to turn things around. Thanks for watching.